In this lesson, we're going to consider another kind of financial capital, called equities or common stock. It's different from a bond, and we'll explain what that difference is in this lesson. Most important difference is an equity or common stock pays a dividend rather than a coupon. It doesn't have a maturity date. It keeps going. And you get a dividend on that bond, on this stock, as long as you hold it. You also have capital gains, as you do with bonds. The price can go up, which it's a gain. The price can go down, which is a negative capital gain or a loss. But the rate of return, therefore, is really going to be the dividend plus the capital gain as a percent of the price. Whereas you should recall in the case of a bond, the rate of return is the coupon on the bond plus the capital gain as a percent of the price. The concept of rate of return is very similar, but you got to think of the dividend. Now, because of this, the price of a common stock, the price of equity, is going to depend on how much dividends the firm will be able to pay out. And therefore, it depends on the expectations of the future profitability of the firm or earnings. The word earnings is used synonymously with profits in the case of common equity in business firms. So the price is going to be higher if dividends are higher, and the price is going to be lower if dividends are lower. And of course, dividends are what the firm can pay out from its profits, and if profits are higher, it can pay out more dividends. If earnings are higher, it can pay out more dividends. So prices of stocks will depend very much on the expected profitability of the firm. And expectations of future profitability can depend on many things. The economy might look better or worse. That will change people's expectations of profits. People can say, oh, this firm has just invested in a new product, it's invented a new product, and so that's going to have profits be higher, the price should rise. So these shifts in expectations will cause the price of equity to change rapidly, depending on what the news is coming in. It creates a lot of risk, and risk is another aspect of uncertainty that you have to think about when you price and think about equities, much like in the case of bonds. Let's consider an example of this. This is the price of Hewlett-Packard stock in in the fall of 2013, August to October. You can see at one date there was a large change in the price, a substantial reduction in the price, and the date is indicated there in the chart. Now that date is marked to be August 21st, 2013, if you look carefully at the chart. And so what do you think happened to make that change? Well, it turns out that's the time that Hewlett-Packard announced the change in its earnings. And so this is a news report issued at the markets closed on the 21st of August. Tech bellwether Hewlett-Packard's long comeback trail took a detour Wednesday when it delivered financial results that fell short of expectations. So as soon as that information got out, and as soon being the next day, the price fell, and it fell substantially, basically like a rocket. And so there's an example of how new information about profitability of the firm, bad information and negative news about the profitability of the firm caused that stock price to drop and drop substantially right away. It didn't take time, it happened right away. And so that makes investing in stocks risky, that kind of thing. There's something called the efficient market hypothesis, which argues that at any point in time, stock prices incorporate all relevant information about future profitability, about the likelihood of the firm having more success or less success. Whatever it happens to be, information that might affect that price. It occurs very fast, changes rapidly in responses to this new information. It's the efficient market hypothesis. In fact, in 2013, Eugene Fama of the University of Chicago won a Nobel Prize, not only for talking about and explaining this theory, but for testing it and showing that many, many securities behave like our little example with Hewlett-Packard. As soon as the noise comes in, as soon as the news comes in, I should say, it gets incorporated in the price very rapidly. That's the efficient market hypothesis. The fact that it gets incorporated in the price very rapidly means that it eliminates any profit opportunities. So you might think, oh, I just read about this disappointing profit result at Hewlett-Packard, I better sell. But you wake up in the morning and you go to the market, you see it's already fallen in price. So someone's beaten you to it. It moves very, very quickly. So it eliminates these profit opportunities very quickly. It's a little bit like the long-run competitive equilibrium model we studied for businesses. In that case, we've argued that if a firm's making money, other firms will enter the business. If the firm is making, to be more specific, economic profits, other firms will enter the business and drive those economic profits down, eliminate that profit opportunity. If the firm is running losses, then firms exit the industry. That takes away from the losses, and you'll move back to zero economic profits again. In the case of these securities, the markets move so quick. It doesn't take any time. You don't have to set up a business to take advantage of this profit opportunity. You just either have to sell or have to buy. So it occurs really within the matter of seconds or minutes. And that's what the efficient market hypothesis is about. When you look at a stock price, effectively it's already incorporated all the relevant information. And it has an important implication for investors, for people that are just trying to manage their money. And it is that unless you have a lot of time, going to be on the trading floor and following things for all your investments very quickly, you better consider kind of having a collection of stocks. It's called index funds. You not just buy Hewlett-Packard, but you buy a lot of different securities. And even if you don't want to just do a simple thing like that, you at least have someone who's watching the markets carefully, a professional manager watching the money. That's one of the implications of the efficient market hypothesis. It's very hard to beat the market, especially if you're doing other things and you have another job or you're in school. There is an issue about how efficient markets really are. Are they really efficient in the way just described here? We've given evidence for it, but there is evidence that sometimes they seem to deviate from this efficient market prediction. And one example of that was in the late 1990s in the US, where the price of high-tech firm stock rose dramatically. It's sometimes called the dot-com bubble. The internet stocks and firms involved with the internet, their prices rose very high, and then they seemed to then collapse. It was kind of like a bubble. Some people find it hard to explain that movement based on profitability or expected profitability. So it looks like they moved more than would be explained by that. So that would be called a deviation from this prediction. Another example is the housing boom in 2004, 5, 6, and then eventually the collapse, which led to the financial crisis in 2008. That rise in housing prices could very well have been due to something other than fundamentals, something other than people really wanted to take advantage of home ownership, other things going on. And so these are examples where you seem to deviate from the prediction. And interestingly enough, in the same year that Eugene Fama won the Nobel Prize, another economist, Yarbrough Schiller at Yale University, won the Nobel Prize for basically pointing out that the efficient market hypothesis doesn't always work. So the combination of these two, it seems to me, reflects the fact that you have a model, it's a good model, doesn't work perfectly all the time, good model, efficient market hypothesis. You got to think about the times it doesn't work that well, and people like Schiller have explored that. Now there's other important implication of this idea of efficient markets and risk, and that is it pays to diversify your portfolio. A diversified portfolio meaning that you don't just have Hewlett-Packard, you have some other high-tech firms, but you not only have high-tech firms, you have, say, consumer services firms, you have firms that are involved in the financial area, different sectors. And so that basically tries to mix the different types of investments into areas which are not correlated with each other so much. So some computers might do well and consumer services might do poorly. It might go in different directions. So by diversifying your portfolio across different sectors of the economy, you can reduce some of the risk. You also can reduce your risk by investing in different countries. If you're always in one country, then if that country does poorly for some reason, bad leadership, bad economic policy, you suffer. But if you mix it across different countries, you're able to reduce that risk. You also can reduce the risk by buying stocks that do differently in the cycle. Some stocks do very well when there's a boom. Some stocks do very well when there's a weak economy. So mixing those together makes sense in terms of a diversified portfolio. Another simple way to put this is don't put all your eggs in one basket. James Tobin of Yale University a number of years ago, he also won a Nobel Prize for showing the importance of such portfolio investments. And when he was asked by the press, why did you win the Nobel Prize? He said, because I showed you shouldn't put all your eggs in one basket. They kind of laughed at him and said, hey, we already knew that. But the truth is, it's a very specific kind of set of recommendations, much more specific than put all your eggs in one basket. And moreover, it works. There's a picture here which illustrates this. This is how much you can reduce your risk. An investor can reduce the risk by diversifying the portfolio, holding a larger portfolio of stocks. In this case, on the horizontal axis, we've just shown the number of stocks in the portfolio. On the vertical axis, what the risk is, the risk measured relative to holding only one stock, like Hewlett-Packard. In this case, you can see that holding 5, 6, 7, 10 stocks reduces the risk substantially. Getting up to 20 reduces it more. At some point, you kind of flatten out so you don't get much less, don't get much more reduction. There's sort of a remaining amount of risk there that you can't go below according to these empirical kinds of estimates that are here. But it illustrates that if you got a portfolio, and it's not just any portfolio, it's got to be a portfolio which mixes together different types of risk and therefore reduces the overall kind of risk, then you can reduce this. Ultimately, though, there's this minimum, if you like, and that would be called systematic risk. And so just to finish this off, even a broadly diversified stock portfolio is still going to be risky. There can be a broad financial crisis which hurts all firms, all stocks. It can be a global recession, which even if your portfolio is in different countries, the whole thing can go down. So diversification is important. It's a way to deal with risk. It's also another way to deal with risk is to make sure that there's efficient market hypothesis. You take care of that by having index funds or portfolio managers to help with that issue. So there's a lot of ways to deal with risk. We've seen how risk affects prices, and we now have basically a complete analysis of the financial markets, bonds, equities, how the prices are determined, and how risk affects investment. Thank you.